Warren Buffett's investing philosophy relies on two simple maxims. Rule number one is never lose money. Rule number two is never forget rule number one. This sounds like an empty platitude. No investor wakes up planning to lose money. During a crash, if your investments drop 50%, a 50% gain won't fix it. You must climb 100% just to reach your starting point. In contrast, recovering from a 10% loss requires only an 11% gain. Warren Buffett's astonishing 20% annual returns since 1965 are the direct result of a framework uniquely engineered to cap his downside risk. Long-term wealth rests on a portfolio engineered to mathematically survive the losers. The first layer of Buffett's defense is intellectual discipline. He prevents losses before he even buys by staying strictly within his circle of competence. He famously applied this discipline when he passed on investing in Microsoft during its early years, despite his close personal friendship with founder Bill Gates. He knew he could not accurately predict the core economics of a rapidly evolving software company 10 years into the future. Straying into complex, unpredictable industries out of hype turns investing into gambling, effectively guaranteeing long-term losses. Early in his career, Buffett followed a strategy he called buying cigar butts. He looked for terrible but ultra-cheap companies, hoping for one last puff of profit. He eventually pivoted to buying high-quality merchandise at marked-down prices, specifically businesses with durable competitive advantages that reliably generate massive amounts of free cash flow. His acquisition of Coca-Cola illustrates this strategy. He paid a fair price for an enduring global brand that continually expands its cash generation. A margin of safety relies on holding highly productive assets capable of weathering severe economic storms. This stability is crucial when dealing with Mr. Market, the allegory Buffett's mentor Benjamin Graham used to describe the manic depressive nature of the stock market. While Mr. Market's mood swings dictate daily prices, Buffett detaches from the noise. He views a stock as fractional ownership, regardless of its quote. He enforces a strict temporal rule. If you are not psychologically prepared to hold a stock for a decade, you have no business holding it for 10 minutes. Emotional decision-making driven by fear and greed reliably destroys a compounding portfolio. To insulate himself from that chaos, Buffett maintains a structural defense. By early 2026, Berkshire Hathaway's cash reserve topped $373 billion. Average retail investors often view cash as a missed opportunity, suffering from intense anxiety during a roaring bull market. But deep liquidity acts as financial oxygen. It ensures Buffett is never a forced seller and always has dry powder when the market crashes. Hoarding cash when others are greedy is a predatory waiting game. It transforms the anxiety of a bear market into a massive buying opportunity. Buffett's fortune dwarfs the earnings of the world's most elite active professionals, like Cristiano Ronaldo, who has amassed an estimated $1.4 billion. Active wealth requires intense daily performance and limited physical time. Buffett's fortune represents the result of decades of passive, uninterrupted compounding. Capital allocation builds generational fortunes through the collective productivity of thousands of workers over decades. Charlie Munger observed that the stock market is ultimately a machine designed to transfer money from the active to the patient. Success requires building a financial fortress that prevents catastrophic loss, rather than chasing short-term profits. Ernest, if you protect the downside of your portfolio, the upside will take care of itself. Rule number one, never lose money, serves as the mathematical engine of financial freedom.